You just raised your first big round, but now your investor wants monthly board updates, quarterly financials, and maybe even to force an IPO within the next 12 to 36 months. Welcome to the world of investor rights and covenants, terms that seem harmless until you live with them. Let's decode exactly what they mean and how to get them right. Hey everyone, I'm Corey, startup lawyer helping entrepreneurs decode law, technology, and innovation. Today's episode is part 5 of our NVCA term sheet series, a detailed playlist designed to walk you through each key term in a startup financing. If you missed part 4 on anti-dilution and conversion mechanics, you'll definitely want to circle back. The link is in the description. In this video, we'll break down registration rights, how they can trigger or force an IPO, information rights, how much is too much, lockup agreements, which protect your IPO, covenants, which are promises your company makes, and mistakes to avoid and best practices to protect your startup. What are investor rights and covenants? Investor rights and covenants are legal guardrails that define the ongoing relationship between you, your investors, and your company. They include rights to information, control over exits, and the power to shape your decision-making often long after the term sheet is signed. Next, we have the broad category of registration rights. There are demand rights, which let investors force you to file with the SEC for an IPO. There are piggyback rights, which let them sell alongside your IPO. Now, founder alert, these can pull you into an IPO timeline that you're not actually ready for, and they should be carefully reviewed. Next, we have information rights broadly. Investors want updates, they may want budgets, financials, forecasts, but too many requests can lead to founder burnout. So during this time, a founder needs to be very clear about the type of investor they're dealing with. Is it a venture capitalist? Is it an angel? Is it a corporate firm? Who is your end investor, and what might those expectations be? This is the time to keep that in mind. Balance is key here. You want transparency without drowning in reporting. Next, we have lockup agreements. After your IPO, lockup clauses prevent early investors from dumping shares on the market immediately. This helps stabilize your stock price and the market perception. Smart founders want to align lockup periods with company goals. Now we have covenants. These are promises to run a company in a certain way. Examples would be operational covenants. They might lock you into board structures or board approvals. There will be financial covenants. They might cap your spending or require certain revenue ratios. The question here is, are the terms overly strict? If they are, they'll tie your hands when you might need to pivot. So let's recap. Registration rights come into play when you have access to public markets. But what are the costs and the pros and cons of how the registration rights sections of an agreement are structured? Information rights. Of course, investors need the proper information, but you need to keep things lean and useful relative to where you are in your financing journey. Next, we have lockup agreements. These are meant to align all parties with the growth of the business, and in the case of an IPO, to prevent massive sell-off that will hit the stock price immediately. Now we have covenants. These can protect your flexibility, or they can constrain you. Founders, you need to negotiate wisely or prepare to lose control. Now this is part 5 of our NVCA term sheet series. Make sure to watch the full playlist to stay ahead on your next financing round. Join me on the path to decoding law, technology, and innovation to grow your business. And don't forget to like, share, subscribe, and hit that notification bell. Until next time.